Ladies and gentlemen, the archivist is here. We are gathered here to break taboos. If you are still obsessed with the detailed movements of aircraft carriers in the Taiwan Strait or the daily press briefings from the Pentagon, you are looking at the wrong map. Military presence is inherently deceptive. They are the noisy layer of geopolitics. They are designed to be seen, to intimidate, and to distract. An aircraft carrier group can be deployed for freedom of navigation exercises on Monday and recalled to San Diego on Friday. It can be reversed. But if you want to understand a superpower's true intentions, if you want to know if they are truly preparing for an irreversible separation, you must stop looking at the movement of troops and start watching the movement of sovereign debt. Debt is the cornerstone of the global order. It is like the heavy, slow-moving tectonic plate upon which nations sit. It takes months, sometimes years, to get rid of key positions without collapsing the global financial system. When the world's second largest economy begins divesting its primary rival's debt at a pace that defies economic logic and market stimulus, it's not rebalancing its portfolio or taking profits. They are laying the groundwork for all-out war. This week, we need to conduct a forensic, in-depth autopsy of the data released by the U.S. Treasury Department. The Treasury International Capital, TIC, report is, by design, one of the most tedious, dense, and difficult to understand documents in finance. It's published belatedly. It's full of footnotes, designed to strain your eyes. But we will read the footnotes. We will look into the dark matter of the financial system. The data confirms a trend that Wall Street has tried to ignore, downplay, or distort for the past 18 months. China's official holdings in U.S. Treasury bonds have shrunk to $688 billion as of October 2025. The Great Unraveling, a statistical catastrophe. For those unfamiliar with the subject, $688 billion still seems like a mountain of money, and it is, but you need to understand the context. In the world of U.S.-China financial relations, this figure represents a catastrophic collapse. This is the lowest level of Chinese ownership since May 2009. We wiped out 16 years of financial integration in an instant. Let's put this into perspective. In 2013, at the height of the symbiotic economic embrace, Chimerica, where China produced and America consumed, Beijing held $1.32 trillion in U.S. debt. It was the main investor in the United States. It effectively financed the U.S. deficit. It bought bonds that allowed the U.S. government to keep interest rates low. This allowed Americans to buy cheap mortgages and cheap Chinese goods. It was a closed cycle of capital flows that kept the global trade engine running. That cycle is now gone. China has liquidated nearly 48% of its positions since its peak. They sold over $600 billion worth of U.S. Treasury bonds. This is a fire sale. But it's not just the total amount that's worrying. The market context of these recent sales is also important. From late 2024 to 2025, the U.S. Treasury market experienced a historic decline. This was a bear market for Treasury bonds. Interest rates were volatile, and bond prices, which moved inversely with yields, were crushed. Anyone selling U.S. Treasury bonds during this period was selling at a realized loss. In the world of corporate asset management, you wouldn't sell a devalued asset at a loss unless you were facing one of two scenarios. Liquidity crisis. You don't have cash. You urgently need cash to pay bills, so you sell your valuable assets at a discount. Strategic shift. You believe the asset will soon become toxic or you will lose access to the asset entirely. We know that China is not facing a liquidity crisis of this magnitude. Despite domestic real estate problems, Evergrande, Country Garden, they continue to have a large trade surplus with the rest of the world. They are swimming in incoming cash flows. Therefore, the only logical conclusion, the only conclusion that aligns with forensic data, is that the Chinese Communist Party has made a strategic decision. U.S. Treasury bonds are no longer a store of value, but a strategic liability. A signal to avoid sanctions. Why suffer the loss? Why burn billions of dollars in realized value? We must look at this through the window of February 2022. When Russia invaded Ukraine, the United States and the European Union carried out a financial maneuver that deeply shook Beijing. Overnight, The G7 countries froze $300 billion of the Russian central bank's foreign exchange reserves. These were funds held in Western accounts in New York, London, and Brussels. Russia thought this money was safe. They thought sovereign immunity protected them. They were wrong. The money was seized, immobilized, and rendered virtually unusable with a few keystrokes. Beijing watched, it analyzed, and it realized a terrible truth. If we make a move on Taiwan, or if the South China Sea conflict escalates, our U.S. Treasury bonds are not an asset, but a hostage. The $688 billion they still hold is effectively a donation to the U.S. Department of Justice. The moment sanctions are imposed, that money becomes worthless. It becomes an item in a court case. So, they're getting out. They're liquidating their positions in an extremely ruthless way. They're willing to accept a 10% or 20% discount on the face value of bonds today rather than risk a 100% loss tomorrow. This is a strategic liquidation. Financially, it's like a burn notification. They're tearing down the great debt wall that stabilized the U.S. economy for 20 years, and they're doing it with urgency. Typically, a central bank tries to hide its sales to avoid upsetting the market. They sell slowly, in small increments over the years. But the speed of the recent decline, they lost about $12 billion in October alone, shows that Beijing is more interested in capital flight than market stability. They want to get the money out of U.S. jurisdiction, and they want it now. 3. Debtor alliance. Who's buying? This has profound consequences for the U.S. economy. For 20 years, the U.S. government was able to run large budget deficits because there was always a price-independent buyer in the East. China was buying debt regardless of yield because it had to reassess its trade surplus. That buyer is gone. China has transformed from the largest buyer to the largest seller. This is creating a massive supply-demand imbalance in the U.S. bond market. When the second largest holder of sovereign debt decides to flood the open market with hundreds of billions of dollars, basic economic rules predict that the price will fall. When supply floods the market and demand disappears, prices fall. In the bond world, when prices fall, yields, interest rates skyrocket. If market forces were allowed to work, China's withdrawal from the market should have driven U.S. 10-year Treasury yields significantly higher than their current levels, perhaps to 6% or 7%. This would be catastrophic for the U.S. economy. It would cause mortgage interest rates to explode. It would bankrupt regional banks. It would make national debt interest payments unsustainable. But interestingly, this hasn't happened yet. Interest rates have risen, yes, but the market hasn't collapsed. Why? Because as China withdraws from the market, the allies are having to step in. We need to take a closer look at the WHO in the TIC data. While China's item value is falling towards $600 billion, other items are rising to historically abnormal levels. Specifically, the United Kingdom, Belgium, and Japan. United Kingdom. The UK share of US debt has reached record levels, exceeding $750 billion by the end of 2025. This puts the UK on par with China as the second largest foreign creditor of the US. Think about this for a moment. The UK economy is about 1/6 the size of the Chinese economy. The UK doesn't have a large trade surplus. In fact, Britain has a trade deficit. Its imports exceed its exports. So, where is Britain getting the money to buy approximately $750 billion of U.S. debt? They aren't buying with excessive profits like China did in the 2000s. They're probably buying with borrowed money or through financial engineering in the City of London. The UK is effectively using its own balance sheet to act as a shock absorber for the US Treasury market. This is geopolitical allegiance manifesting in financial risk. Belgium. Next, there's Belgium. According to the latest data, Belgium's assets generally hover between $320 billion and $370 billion. Did the Belgian government suddenly become overflowing with cash? No. Belgium is the center of Euroclear. Euroclear is one of the world's largest international central securities depository institutions, ICSDs. It forms the backbone of the global financial system. When you see Belgium buying U.S. debt in the TIC report, it's rarely the Belgian government. It's usually a proxy institution. More often, it's other central banks, sovereign wealth funds, or custodian accounts that try to conceal their activities. This creates a layer of anonymity. However, the increase in assets in Belgium and the UK at the same time that China is selling indicates a coordinated effort by G7 countries. C. Coordinated defense. This is a bag-holding alliance. This is not a free market decision. Why would a rational investor in London or Brussels aggressively buy U.S. Treasury bonds right now? The U.S. has a $2 trillion budget deficit. Inflation is persistent. The currency is being used as a weapon. Currently, buying U.S. debt is a risky undertaking. The fact that allies are turning to it indicates geopolitical pressure. Washington is effectively telling its partners, China is dumping. If you don't intervene and absorb this supply, the U.S. bond market will collapse. If the U.S. bond market collapses, the global financial system will collapse, and we won't be able to protect you. This is a kind of financial compulsory service. The West is blocking its own balance sheets to absorb the supply from Beijing. However, this strategy has a fatal flaw: capacity. China, being the world's factory, had almost unlimited capacity to buy debt. They were earning real dollars by selling real goods. Britain and Europe don't have that capacity. They are already struggling with their own debt burdens, slow growth, and energy transitions. By forcing them to buy U.S. Treasury bonds, Washington is depleting the liquidity of its own allies. They are weakening the periphery to rescue the center. This creates a fragile system. If the UK economy falters, as we saw during the 2022 LDI crisis, they may be forced to sell these Treasury bonds to raise cash for themselves. If that happens, the last resort offer disappears. The Great Transformation 4, from paper to physical. While the West is busy shuffling paper liabilities amongst themselves, China is taking the money and running it to the only place the U.S. Treasury can't touch, the physical world. When China sells a U.S. Treasury bond, the transaction takes place in U.S. dollars. The People's Bank of China takes a digital loan in an escrow account. But here's the problem: China doesn't want dollars. As we've pointed out, dollars are a liability. They are traceable, subject to sanctions, and inflationary. So, what are they doing with the proceeds from this massive $700 billion outflow? They're not hiding the money under the mattress. They're not buying euros. They're embarking on the most aggressive commodity accumulation drive in modern history. They're transforming paper rights into physical reality. To see where the money is going, we need to follow the cargo ships entering the ports of Qingdao, Shanghai, and Tianjin. While Western analysts are watching bond yields, Chinese state-owned enterprises are swallowing up record amounts of raw materials. This isn't building up a commercial stockpile. This is a war stockpile. 1. Gold pivot. As discussed in previous briefings, shadow control, the People's Bank of China has been a relentless gold buyer. Officially, they have been buying gold continuously for over 18 months. Unofficially, withdrawals from the Shanghai Gold Exchange indicate that the purchases are much larger. They are using dollars from bond sales to buy metal from London and Swiss markets and ship it east. Gold is the biggest threat to the dollar. There is no counterparty risk. It cannot be frozen by the SWIFT system. By exchanging U.S. debt for gold, China is shifting from credit-based reserves to collateral-based reserves. 2. Energy lifeline, crude oil. China imports 70% of its oil. This is a strategic Achilles heel. In a war, the U.S. Navy could blockade the Strait of Malacca and deprive the Chinese economy of energy. To counter this, China often buys record amounts of oil from sanctioned countries such as Iran and Russia. They are paying with yuan instead of dollars, but most importantly, they are filling their strategic petroleum reserve to full capacity. Recent data shows that China's crude oil stocks are approaching 1.5 billion barrels, both commercially and strategically. Satellite imagery shows the construction of massive new storage facilities and underground caverns. They are creating a buffer zone that will allow them to withstand a naval blockade lasting months, perhaps years. The money for this oil is coming from the liquidation of U.S. assets. 3. the metal mountain and copper and critical minerals. This is the most telling signal. China's real estate sector, historically the largest consumer of copper for cabling and plumbing, is in crisis. Real estate construction has slowed, yet China's imports of copper ore and concentrate are near all-time highs, around 28 million tons in 2024. This defies standard economic logic. If you're not building apartments, why do you need so much copper? Because you're transitioning to a war economy. You need copper to reduce dependence on imported oil for a green energy grid. You need copper for ammunition. You need copper for drones and electric vehicles. China is seizing the market for physical inputs for the 21st century military-industrial complex. They are also stockpiling cobalt, lithium, and rare earth elements. While the U.S. is financializing its economy, China is materializing its savings. 4. The fortress of food security. China accounts for 20% of the world's GDP, but possesses only 7% of the world's arable land. This is another vulnerability. In contrast, China has amassed enormous grain reserves. According to the U.S. Department of Agriculture, China holds approximately 60% to 70% of the world's global corn and wheat reserves. They have enough grain reserves to feed their population for more than a year without a single import. They are exchanging calories instead of interest earned on yield bonds. A shift in mindset. A country planning to remain at peace will hold its wealth in productive, interest-bearing financial instruments like U.S. Treasury bonds. It seeks the highest return on investment. A country preparing for conflict, however, will convert its wealth into unproductive physical stockpiles. Holding 500 million tons of copper doesn't yield interest. In fact, it's costly to store. It has a negative yield, but it has a tremendous return on survival. China is willingly accepting a lower financial return today to avoid drowning tomorrow. This explains the losses they've experienced in bonds. Western economists mock China. Ha ha, they sold at the bottom. They lost billions of dollars. This is a short-sighted civilian way of thinking. Beijing isn't concerned with the loss in market value in fiat currency. They're concerned with resource security. If they sell a bond at an 80% loss and use the proceeds to buy oil, which they'll desperately need if the Strait of Malacca closes, that's a profitable transaction. V. Archivist Protocol, a survival guide. The conclusion is simple but frightening for the average investor. U.S. Treasury bonds have become a battleground. For 40 years, a 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard of investing. Bonds were the safe haven. They were the ballast that kept the ship afloat. That era is over. U.S. Treasury bonds are no longer a risk-free asset. They are a political tool in a global economic war, an asset class increasingly dependent on the favor of foreigners who are becoming enemies. If China, the largest domestic player in the global manufacturing world, is exiting the market, you need to ask yourself a very serious question. Why are you staying in the market? So, how do you position yourself in a world where the biggest buyer is exiting the market? You follow the archivist protocol. Rule 1. Shorten your maturity. If you hold bonds, you need to understand maturity risk. Maturity is a measure of how sensitive a bond's price is to interest rates. Long-term bonds, 20-year, 30-year Treasury bonds, have high maturities. If interest rates rise by 1%, the price of a 30-year bond could fall by 20%. As China exits the market, the structural pressure on long-term interest rates is upward. Even if the Fed lowers short-term interest rates, the long-term interest rate curve, determined by supply and demand, is vulnerable to a buyer strike. If China sells and the UK also exits the market, yields must rise to attract new buyers. Rising yields mean falling prices for existing bondholders. Recommendation: don't hold on to long-term U.S. government bonds. These are the assets most vulnerable to Chinese selling pressure. Alternative: if you want security and yield, hold your money in short-term Treasury bills for 1 to 6 months. Short-term bills have virtually zero maturity risk. They are less susceptible to geopolitical sell-offs. They act as a cash equivalent. Be like China. Be liquid. Invest short-term. Don't lock your money up for 30 years with a government waging economic warfare. Rule 2. Follow smart money. China is selling paper money to buy goods. You should consider doing the same. Your portfolio needs exposure to energy, metals, and real assets. This isn't just about profit, it's about hedging against inflation. Consider the final act here. If China sells $688 billion and the Allies eventually stop buying, who will buy the debt? The Federal Reserve. The Fed will have to step in as the buyer of last resort. They will have to print trillions of dollars to monetize the debt. When they print trillions of dollars, the value of the dollar falls and the price of the good rises. This is the inflation cycle. China knows this. That's why they are buying goods now. Action. Own the producers. If China is stockpiling copper, own the miners. For example, Freeport-McMoRan, Southern Copper. If China is stockpiling oil, own the energy producers, for example, Exxon, Chevron, Shell. If China is stockpiling gold, own the metal or the royalties. Philosophy. You want to own what matters, not the currency that buys it. Rule 3. Watch the canary, USD JPY. You need a warning signal. You need to know when the bag holder alliance is breaking down. Watch the currencies of key U.S. allies, especially the Japanese yen. Japan is the largest holder of U.S. debt. However, Japan is struggling with a currency crisis. The yen is highly unstable. If Japan is forced to intervene to rescue the yen, it will have to sell U.S. Treasury bonds to obtain cash to buy its own currency. If Japan joins China in selling, it means game over for low interest rates. Signal. Watch the USD JPY exchange rate. If the yen falls towards 160 or 170, or if Japanese bond yields rise, this means the bag holder alliance is breaking down. That's when the U.S. Federal Reserve will have to intervene. That's when the turning point occurs, not because inflation is defeated, but because the Treasury market is collapsing. 6. Conclusion. Countdown. The $688 billion figure isn't just a statistic from a government report. It's a countdown clock. China is systematically and deliberately withdrawing itself from the U.S. financial system. They're dealing the cards. They're willing to suffer losses today to ensure survival tomorrow. They're trading digital promises for physical reality. Don't interpret the current stability of the market as security. This is artificial stability supported by political pressure and borrowed money from Europe and Japan. When that support disappears, it will be violent. The divorce is final. We're just waiting for the house to be sold. Get rid of long-term debt, access physical assets, watch the streams. Don't forget to subscribe to the channel. See you again tomorrow.